Forex trading, and the term Forex trading stands for foreign exchange. And Forex trading is simply the terms is the trading in currency between different countries, mostly two different countries, against each other. For example, the USD dollar against the euros. We even also have a conversion of one currency into another. And this market is over like 5 trillion volumes, dollars in volumes, more than trillions, because every day the market generates, it runs into billions of billions of billions of dollars. And it's a like use the word, it's a skill that even your banks use them without you knowing. You think you're just putting money in the bank, but your bank actually trades Forex. They trade all these pairs even without you trading it yourself. So that is how the banks that we put our money in make their profits. They don't make profit off just the charges they are charging you, the bank charges you are seeing. They make profit off the Forex trading they do within the bank. So the amount of currency converted every day can make price movement of some currencies extremely volatile. And it is this volatility that can make the Forex so attractive to traders, bringing about greater chances of high profits while increasing the risk. Name, good evening. So move to the next slide. How does the currency market works? The Forex market is run by a global network of banks, like I said earlier. They spread across 4 major Forex trading centers in different time zones. Now we have the London section, we have the New York section, the Sydney and the Tokyo section. Because of there's no central location, you can trade 24 hours a day. And the Forex market is being opened from Mondays to Fridays, and most of the time, due to different time zones, if it's Nigeria here, the market opens from 10 p.m. Sunday night. But it is each time zones that you are seeing here, that's the London section, the New York section, the Sydney and the Tokyo section, have a way you trade them. You don't really trade during some certain section because the market is always very volatile and it's always very tricky and crazy. Like Asian section, which is the Tokyo section, the market is very, 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 very volatile. That any trade you take during that time, you might just be losing the trade. Even though your trade is going your way, the manipulation rate is always very high because the market is just opening at that point in some banks and mostly on some pairs. So even if you are trading some certain kind of pairs during the Asian section, it might still go your way, but it's the volatility rate and at that period, that's the spread during that period is always wider. I hope you guys understand. The spread is always wider during this certain period of time. This are what makes the markets, like during this time zones, and then each time zones have their spread. Sometimes like New York section, the spread level is always very low. These things are not really manipulated by the broker. Most of the time, it's just how the market is around the time zones on in trading during Forex. And so we have type of Forex trading. We have the spot Forex market, the physical exchange of currency pairs, which takes place at certain points the trade is settled on spot or within a short period of time. That is what we do physically. I want to buy dollar, you give naira, or you give your Uganda cedis, so Uganda's currency for naira, Uganda cedis for your dollar or stuff like that. That is spot trading where you make transactions quickly. You're not trading the market directly. You're just making the transaction physically outside the market, but it still affects the markets. And we have the Forex, the forward Forex market, a contract agreed to buy or sell a set of amount of currency at a specific price to be settled at a set date in the future or within a range of the future dates. We also have future Forex, a contract that agreed to buy or sell at a set amount of given currency at a set price, date, and in the future. Unlike forwards, a Forex contract is a legal binding. So we have most traders speculating on Forex prices would not plan to take delivery of the currency itself. Instead, they make exchange rate predictions to take advantage of a price movement in the market. So this is clearly just saying that, when we're analyzing the markets, we predict where price will likely get to, and then it will either rise from there or it will fall. And then that's where you see traders saying, oh, the USD will rise at certain points in the market. When it gets to certain area, price tag, and people will be arguing, oh, the currency is stable, or the currency is this, the currency is that. But a Forex market analyst, that's what we call ourselves, even if you do Forex or crypto, anything, you analyze the market. When we analyze the market, we easily predict the point where market is likely to drop or market is likely to kick off from there. So if market is dropping, it means it is selling or a retracement or pullback. Those are kind of the terms we use. If market is dropping from our point, or if market is going higher. The market is going according to our direction in the market, we say it is an impulse movement. When the market is going against the direction of the market, then we can say, oh, that is a retracement. So when we as Forex traders make our analysis, we easily can be, if price gets to a certain place, we're expecting price to drop. We're expecting price to retrace and go back and kick off from a certain point in the market and take off from there and continue going the direction it's meant to be going to. That is what we do as Forex traders. What moves the Forex market? The Forex market is made up of currencies from all over the world, which can make exchange rate predictions difficult. Please, can you mute yourself? Someone's mic is on, or let me just mute everybody. Yeah. Thank you. So the Forex market is made up of currencies from all over the world, which can make the exchange rate predictions difficult, as there are many factors that can contribute to price movement. However, like most financial markets, Forex is primarily driven by the forces of supply and demand. It is important to gain an understanding of the influence that drives the price fluctuation. Like if we had a chat on WhatsApp, you realize that there were questions that were being asked, right? We're asking what do you use to trade the markets? What are your challenges like? Because the market is not just made about candlesticks only. It's not just candlesticks that influence the market, the way most traders will make you believe that, if you just know the candlestick to go your way, even if you know a candlestick, you know what the market is telling you, right? You will still be losing money because the candlestick is there to just give you a direction, a heads up, or must I say, confirmation that it might likely go your way. Doesn't mean it's going to go your way, because it's sometimes a market might get to a certain area you are expecting it to get to, and you see your favorite candlestick. That doesn't mean that the market is still going to go your way, because there are certain things that contribute to the market trends, the supply and demand area, support and resistance, the change of market trend, where market is moving at that point in time. Market can be going in a very downwards direction, and then decide to change and start going upwards. And you are still following the overall trend of the market, which is a downwards, and you don't know why you're hitting the SLs. It's not because of your analysis is wrong. Most of the time it's because there are some certain key things you did not obey. So people will say, oh, they trade only trend lines, and then you trade the trend lines and you see that it is beyond just trading trend lines. So there are certain things that the market follows. Market obeys structure a lot. So you see so many people will say, oh, the market has been on a very, very long structure for a very long time. It has been going up. Very soon it's going to drop down. You'll be wondering why. Because they've already decided that they've analyzed the market from their, the time frames, the higher time frames down to the lower time frame. They've done everything they need to use. They've put in the liquidity they need to see, because market also has liquidity, which we'll teach in the future what liquidity is all about. But all these things make up the market. From your market structure to how the market works, the chart patterns that most of you already know, they influence the market, not just saying, oh, if price gets here, that is it. So if you only know just candlestick, you just know the tip of Forex. You just know the tip of analysis. That's not the only thing that makes up the market, because you can know the pin bars, engulfing candle, three soldier. You can know head and neck patterns. You can know double top, double bottom. You can know all these patterns, but if you do not understand what the market is really giving you, and you're using all those things in the market just like that, you would be profitable, but you would not be profitable at the same time. you'll be chopping SLs back to back, back to back, and you're wondering, why am I chopping SLs? Like, why am I hitting, losing more money? What am I not following that guys in markets? So we move to the next part. What influences the foreign exchange market? That's the Forex markets. We have the central banks, we have the news reports, we have market sentiment, we have credit ratings and economic data. All these things are the ones that influences the markets. Banks can decide to say, okay, there are some liquidities that need to be taken out, and the banks will target those liquidity areas and put their money in there. You will be waiting for, want to get into the market at that point, and the banks will just take your money. It's not like your analysis is wrong, but because there are certain things that you do not observe. Sometimes you hear people saying they trade the news, fundamental analysis. They're the ones who trade the news. They are the ones that they know what's up, how want to happen. They understand that this kind of news from the financial markets influences the trade. So it's either the news make the trade go in their favor or against them. So news has a very major effect, but not all kind of news have a major effect on the foreign exchange market. The only news that have effects are the high impact news. They have high impact effects in the market. The trade might go against you or might follow your trades. So it all depends on how you enter your trades, how smart you can be, understanding what you want, your principles and what guides you. Do you trade news? No, you don't trade news, you leave news alone. Or you trade news, no problem. Or if the trade is going your way, fine, no problem. All these things they're the ones that make up the market. What the big players, you call them the whales, things about the markets and all of that. We have the whales who know what's supposed to be, what is going to happen in the market. Some people have already, predicted how the market to go for the month. Okay, this month, this is how the market is going to go. So this is where I'll wait for market to come and get to my point. Those are like the position traders. We'll explain that in the future, next class. But those people also influence the markets. And then the economy also of that particular currency pairs or that particular currency that is moving the market at that point. The economy determines what will happen to the pair, a particular pair, maybe the USD, for instance. If the USD economy is dropping bastardly, it will show and reflect on the charts. If the trade is going, the currency is very, very strong, it will show on the charts. So people can easily predict that, okay, if price gets to this particular place, there's likely price is going to fall a bit. There's likely that price is going to fall a bit, and then it will start going your way from there. So all these things influence the markets. So how much is being traded in the Forex market daily? We have approximately $5 trillion worth of Forex transactions that take place daily. And then which is an average of $222 billion per hour. Also, how does Forex trading work? So this is how it works. I'll show you a chart. Okay, let me see if I can reduce this, please. So right now, what you are seeing here is MT4. Yeah, basically MT4. I think MT5. So, but what I'm seeing here right now is from the MetaTrader broker app. So all these things you are seeing here are trades that are being taken live, and then these are amount deposited, and this is deposit, this is profit, this is the overall balance. So now we trade these pairs. These pairs you are seeing here are currencies of two different countries, euros and USD. The gold pair, these are metals, gold and USD. We trade these pairs and we make money. So if these pairs are going up, we still make money. If they are going down, we still make money. If they're going down, we still make money. This pair was literally falling, and we made, though it was in red, but it ended in profit anyways. And sorry, you can see this one was buy, and that means it was a bullish run, it was going up. So all these things you are seeing here are what we trade and how we make money. This is how Forex work. We take all these trades and we trade these pairs, no matter the direction, as long as we know what we're doing in the markets. What makes up the Forex trading? We have the brokers, the spread, the pips, the profit or loss, take profits, stop loss, entry price, the current market price, lot size, and currency pairs. First off, we'll be explaining what's this meeting. We only have a few minutes left, but I'll send another link. First off, we're explaining what a broker is. Brokers are firms that grant us access to the Forex market through MetaTrader 4. So they are intermediary between us and the Forex market. Now, the commission that your broker will charge you from your account when you are placing a single trade. Now, the pips is the price index point. This is a unit of measurement to express the change between two major currencies. This has the pips movement. And we have take profits. It is distance you want to get your gain from the market, and then your stop loss is like your safety net. It's the limit you set to save yourself from more losses. When there's no stop loss in a trade, you tend to lose more than gain more. So it's best to just set your stop loss wisely with proper risk management. Your entry price is when you click enter or buy. That is where you get your entry price. And the current market price is the FX market that is already running on an ongoing trade, That is your current market price, where market is likely reaching or running to or moving at the same spot. And the lot size, this determines the percentage you can either gain or lose in a given trade. There are three types of lot size. We have the standard lot, we have the mini lot, and then we have the micro lots. So the standard lot is the 1.0 to infinity. Sorry. The standard lot is 1.0 to infinity. That is 2.0, 10.0, 50.0, any amount you want to use. You want to use per or lose or gain per lot size. Lose or gain per lot size. And for a 1.0, that is a $10 per pips. So if you are using a 1.0 in some trade, that is $50 per pips, right? And then for you to calculate this manually, you can do 1.0 times 40 pips. And you will do this way. You do it with a 1.0 equals to $10 per pips. And then you say $10 times 40 pips. That is, you're likely wanting to try to make $400, depending on your account. Now, a standard lot size is for accounts starting from at least $1,000 upwards, or let's just say $5,000 upwards. You can use a 1.0 from $5,000 upwards. But people do use 1.0 on a $1,000 account. But then you have to not know your risk. Are you going to use one position? Are you going to use two positions? Because if you blow your account, that's depending on your lot size for your stop loss. Like how many lots are you, your pips movement for your stop loss or your take profits. So if you are using a 20 pips, for instance, for your SL, and you're using two positions, for instance, for a $1,000 account, you know that it's likely you are going to be losing $400 to make at least $800 profits on your trades. So this is how you calculate, you know what you're trying to do with your lot size, depending on the account you want to use, or depending on the account you are planning on using, your funded accounts. So we have the mini lot, which is a 0.1 to a 0.9. With a 0.1, it means $1 per trade, per pip, sorry. So it goes this way. We are using a 0.1 times 40 pips. Then it means you want to make $40 on that particular pair, all depending on the kind of amount you are funding. So if you are using from a $1,000 downwards, you can, or $1,000 or maybe $1,000, you can use a 0.1 or a 0.5 or a 0.2. For anything below that one, below $5,000 down, 40 or 4K or 3K or something, or even $500, you can use a 0.1. It all depends. Proper risk management and all of that. Then you have the micro lots, which is a 0.1 to a 0.09. And a 0.01 stands for 10 cents per pips. So let's say you are going for 10 pips. So 0.01 equals to 10 cents times 10 pips will give you at least 100 cents or $1. So if you are going for 40 pips, it means you are looking at making $4 per trade, depending on your account size and your number of positions you open, which will be taught later. I don't want to make everything. I hope you guys understand. If you're not understanding, please drop comments and chat that you don't understand. I want me to recap on something. Then for formula for calculating your lot size, like I said earlier, your capital is like your key thing. But yes, your capital will let you know how kind of lot size you need to use. And then it will be your capital divided by $5,000. $5,000 is a fixed price. So let's say you have like $50 on you as our funds, it will be 50 divided by 5,000, which is going to give you a 0.01. And then you have to use that lot size 0.01 for that your account, which is 10 cents. And then you use your calculator to do your math. So if you're using like a $500 account, for instance, you divide it by 5,000 and to give you a 0.1. That is $1 per pips movement. And then not even per trade though, but per pips movement anyways. And then this means you're using a mini lot size for that kind of account. So if you're using a $5,000, for instance, if I divide it by 5,000, it means you have to use a 1.0. So that means for each pip movement, it is $10 on a 0.1 lot size if you are using a 5K account. So this is a standard account for any trading account. Like this lot size is the standard lot size for your trading account of this kind of amount of money. So if you are using, like for instance, if you don't calculate the kind of number of pips you want to use, if you don't know what you are doing in the market, you can easily blow your account, because why would you be using a 1.0 for a 1.0 lot size for a $500 account? So this is why most people tend to lose money, like they blow account, because they don't sit back to calculate the lot size that you use. And then all this matters most in your risk management. They matter a lot when it comes to your risk management. So there are about 8 major pairs. This Zoom meeting will soon go off, but I'll send another link shortly. So there are about 8 major pairs that we trade: the United States dollars, the Euro FX, Euro zones. I hope you guys can hear me. Please indicate if you can hear me in the comment section. Okay. Can you guys hear me?
Yes, okay.
Okay. So we have the NZD New Zealand dollars, that's NZD. We have the Canadian dollar. We have the Switzerland dollar, that's the CHF. We have the Japanese yen, that's JPY. We have the AUD, Australian dollar. You can't trade a single pair, but we can trade two currency pairs. So when one pair or this 2 pairs like this combine together, we can actually trade them. That we have the Euro USD, we have NZD USD kind of pairs, we have CAD USD, or we have CAD JPY, for instance. We have GDP, Great Britain pounds, that's GDP, and Japanese yen mixed together. We trade them. We have GDP to USD, Australian dollar, we trade them. We have GDP to Canadian dollar. So all these things pair up together. So for instance, this is how it appears, right? So we have the Euro USD, that euros is the base, and the counter or the quotes is the USD. Now the base currency tells the direction of the market, which can either be buy or sell. And this is just like USD also. The USD deals with the XY, what the market wants to do. And sometimes the trade is going against you. It means this might be going against this. I don't know how best to put the language to break it down at this point, so people cannot get confused. But let me I think I shared something like a screenshot. So this is what I'm trying to say here. So we have Euro USD, we have this USD pairs right now. And then most of the time, these quote pairs, this USD, for instance, has its own it has a currency the currency index that tells us what the USD might likely want to do, and that the USD is falling, and then we will now use that analysis that we get from the XY. Most of the time, we don't really use the XY anyways, but that will tell us if this USD is weak or strong, and it will tell us whether the base pair is going to go against this pair, is going to like move ahead of this pair on the USD. Okay, someone dropped a comment. Okay, you guys can hear me good. So it's going to tell you whether this pair, if this pair is weak, we can literally say, okay, this USD, if USD is weak, we know that the base is stronger and might be going according to the trend that we're seeing is going to. Most times, if this is stronger than this, then the trade might go against us and might not really be going our direction, might not really be going according to the trend. That's why I see some people who say I analyzed USD and I've seen it go this direction. Likely, the USD or all USD pairs might fall. And you're wondering why are they saying it might fall, but you don't understand why it might say it might fall. Because they've already seen that on the DXY chart where they've analyzed the market, the pairs already maybe getting weak. And if the pair is getting weak, that means other pairs will be going over it. I don't want to complicate people's heads, so let me just leave that. So we are here. So there are other names for buy and sell. We have the uptrend for a buy. We have the downtrend for a sell. We have the bullish for a buy. We have the bearish for a sell. We also have strong for a buy, and we also have weak for a sell. We have long for a buy, and we have short for a sell. And the colors of the buys and sells on the FX chart, when you see red candles, they mean just that red candle is a sell candle. It means market wants to sell. It's a sell candle you're actually seeing there. When you see green or blue, some charts do blue on their FX chart. You see a blue candle. It also means a bullish candle or buy candle. And some charts you see a green candle. I will share my trading view with you so that you can literally see one of the trade setup I'm actually doing at the moment. So you can see my chart. Okay, I don't know if you can see it. Okay, I explained that earlier on PIP, so I think we'll recap on that again. Let me just show you the candlestick experiment, this thing. So can you guys see my trading view? Can you guys see my trading view? If you can see the trading view chart, let me know. Signify in the group in the comments. My chat scattered. Please signify if you guys can hear me and see the charts. Okay, good, Alex. So you see these green candles here that you're seeing here, all these green. It is called buy candle. So when you see a trader will tell you, oh, the market is currently buying, you can go and check your chart. You see that you are going to be seeing a green candle. Some people's chart, you will see it as blue. Some people can decide to be very, very crazy and change their chart color to red, to maybe green or black, or anything they want it to be. Some prefer to just use red colors to identify the chart according to their own psychology and how the colors help their site. Some people, you just see white and black and be wondering which one is the sell, which one is the buy. And they'll be like, oh, the white is the sell, the black is the buy. They can just mix it up. It's left for them to see what they want to see and how they identify the market's candles by yourselves. And when I said not all candlesticks that you're seeing here, not all candlesticks indicate something. Some candlesticks will tell you yes, but if the market, the trend at that particular point in the market is going this way, bullish, for instance, and I'm seeing some candles and I'm saying, oh, it's going to sell. It's going to continue selling down, and you start going against and you chop SL. You're wondering, why did I chop SL? And where did the SL come from? It's because we don't really do proper analysis. And then you see this kind of movement, it's all going uptrend. You hear people saying like things like, oh, the market is currently bullish at the moment. It's going bullish or on a bullish trend. this is what is indicating uptrend. This is an uptrend, and then the market is literally just saying we are currently in a buy movement. So let me just draw the line so that I can see something like that. This is what you are saying. This trend is currently going up, and then when you see up like this, is a buy movement that is currently ongoing. This is a buy movement. And when you see trades like this, and you see a pattern, a market going down this way, let me just do it so you understand what a buy and sell is. This is a bearish movement. Be it on your higher TF or your daily, for instance, you can see the market has been down for going down, down, down. You say this is a bearish movement and the market is currently still going down. This is still a bearish movement. That is a sell movement. Now, market is currently going up like this. This is a bullish movement. I hope you guys understand what I'm talking about between the buy and sell we were talking about on here. Please, do you guys understand what I'm saying about the buys and the sells? Oh, Jesus. Okay. Please comment. Please ask questions. Do you understand what I'm talking about buy and sell? So you can understand when people say, okay, good. You understand when people say, oh, the market is currently going on a bullish movement. So if in case you're on Twitter and you're seeing people talking about a market movement, saying the market is still very bullish, it means it's still going on an upwards movement. Or the market is, or this pair is currently strong. It's a very strong US is currently strong. You realize that US is currently bullish. Or you see JPY is currently strong, JPY is currently bullish. You easily understand the language traders use, because not all traders use this. Oh, it's an uptrend, it's a downtrend, it's going upwards, going downwards. They tend to always use terms like bullish, bearish, strong and weak, or I'm going long on this pair, I'm going short on this pair. Some terms are just like indicating, oh, I'm currently going to sell this pair, or I'm currently going to just go in and I'm not going to stay long in the trade. It might just be 1 to 30 pips, or sorry, 10 to 10 pips short. And you'll be like, what is that? He's saying short. It's not going to be a bearish movement. They'll be like, it's not going to be a bullish movement. They'll be like, no, I'm going to sell. So you need to understand these terminologies are like very, very easy to understand. Someone was asking about pips.